All right, everyone. Thanks for coming out. Really appreciate seeing a number of familiar faces here. I'm actually going to just go into the chat and allow everyone to chat, just in case anybody wants to put any questions in there. Let me just go ahead and do this. There we go. Now everyone can chat. I'll go through the presentation, and then if anybody has any questions, please do put it in the Q&A. I'll be happy to answer questions at the end of the presentation. So why are we here today? We are here to talk about managing cash flows with higher interest rates. Obviously, it's been a crazy ride. We've seen interest rates rise significantly over the last, really, it's been about 12 months. And so it's just really a matter of trying to understand, what do you do when interest rates are flying through the roof? So let's first talk about interest rates. I want to address what's already happened, and we can start to get into how to manage what's been happening. So first off, let's talk about the Bank of Canada. The Bank of Canada hikes the rates for the 8th straight time. So they started earlier, only about 12 months ago, and have now risen to an overnight lending rate of 4.5%. Now, just to give you an indication of what that means, that's the bank's overnight lending rate. So the banks, when we went through COVID, they went to 0.25% for their overnight lending rate. Now they're up to 4.5%. Another way to look at this, the prime rate is 2.2% higher than this 4.5% rate. So the prime rate has moved all the way up from 2.45 up to 6.7%. Quite a bit of a jump up. Not the first time that we've seen interest rates rise this quickly, but it has been a very long time. The last time we've seen interest rates rise at these type of levels was back in the late 70s and early 80s. And of course, back then homes were $100,000, a lot cheaper than your typical starter home in Vancouver nowadays. So it's obviously causing a lot of people to be very concerned about what's happening. Now, the Bank of Canada isn't the full picture when it comes to interest rates either. You also have the bond yields, and the reason that I have a bond chart here is that fixed rates are highly correlated with bond yields. If bond rates start to go up, then fixed rates will start to move up. And that's because lenders, what they do is they package up mortgages. So they lend out to you and me, they package up the mortgages, and they turn around and they sell them out the back door. And what they're doing is they're just collecting a spread between the interest rate that they're collecting from the customers and then what they're paying an investor behind the scenes. It's called a mortgage-backed security. It's actually what caused the U.S. subprime crisis back in 2007, 2008, when mortgages were getting bundled up, especially in the U.S., being called AAA, but they're actually full of junk mortgages. And so this is an issue that we've been facing for years, but it is the way that the financial system works, and that's why mortgage rates are very closely tied to bonds. Now, the chart that I have here is showing you the climb up for a number of years, for quite a while, about a year and a half. Bonds were very, very cheap. They're about the 0.4%, 0.5% range for quite some time. And you can see there's a couple of moments where the bonds started to go up. One of the easiest ways to look at it is, in general, economic growth and positive news usually means that interest rates are going up. Negative news usually means that they're going down. The only thing that you'll see is that inflation is generally a good thing when it's under control, but a high inflation is probably one of the things that would push interest rates up, but can be viewed as a negative thing. So in general, inflation is good. You want a growth rate in a growing market. You want to see that, and usually the target inflation for most central banks is about 2%. You want to see that things are slowly increasing, and that means that there's economic growth. However, inflation, when it starts to exceed that number, starts to become concerning for central banks. And this is something that they're always looking at and trying to monitor. So obviously, yes, usually when interest rates are rising, it's usually because people have jobs, people are spending money, and the market and the economy is growing. However, there is one caveat to that. If the inflationary rate while the market is growing is too high, then that can be viewed as something negative. So you can see here, there's a number of different reasons that the bond markets had moved. Now, back in October of last year, so October 2022, the bond market hit a high of about 3.8%. And a little bit later in the presentation, I'd actually like to show you what's currently happening in the bond market, because rates have not not continued to climb. They've actually started to decrease from that level. And so that's something that I'd like to discuss and go over with everyone, just to understand, where are we going moving forward on interest rates. Here's an interesting chart that I found when I was actually putting this PowerPoint together. This is the Bank of Canada target rate forecast out to 2023. This was done in January of 2021. And this is interesting because it's showing that most people were predicting the Bank of Canada were not going to increase interest rates well into 2023. In fact, this chart is going all the way up until Q1 of 2023, which is where we're at today. And it shows that the Bank of Canada is going to stay at the very low rate of 0.25%, which would have been a prime rate of 2.45%. So you can see that most people predicted that the rates were not going to go up. In fact, some predictions earlier on were even anticipating perhaps the Bank of Canada wouldn't be moving up rates until late 2023 or even early 2024. Obviously, we know that that is very, very wrong and is not exactly what happened. So interest rates have risen. The big question is, how much would a rate hike impact you? So if you're in a fixed rate mortgage, then you're good. You're not seeing any increases to your interest rates yet. But if you're in a variable rate mortgage, then you are seeing interest rates increase. Now, the reality is on a per increase basis, it's actually not that much money per month. Every $100,000 you're borrowing, if the rate goes up 0.25%, about $12 a month. So maybe 2 Starbucks fancy coffees per 100 grand. Generally, that's fairly affordable. The problem is that we've had a 4.25% increase to the prime rate. That's effectively 17 quarter-point increases, which really adds up, especially on a $500,000 mortgage. Now, all of a sudden, we're talking about $1,020 per month per 100 grand is the increase to the payments. Now, that's a lot more difficult for your typical Canadian to be able to afford if they're in a variable rate mortgage. So this is the concern we're dealing with. This is when people are saying, oh my gosh, well, what's going to happen? They're getting your mortgage statement, and every single month, the Bank of Canada keeps going up and up and up, and people are starting to freak out, and for very good reason. Now, it's not only impacting people that are variable rate holders, it's affecting those that are coming up for renewals. If you had a 5-year fixed rate they took in 2018, you're coming up for renewal this year, and you're going to probably see some payment shock. Luckily for those, well, I should say kind of luckily for those that took mortgages in 2018, at least that was the last bit of a high as far as interest rates are concerned. So late 2017, early 2018, a lot of banks were in the mid to high 3s or even the low 4s, depending on what kind of mortgage you're taking. So it's a little less of a payment shock. Once we start getting into 2024 and 2025, those borrowers that took mortgages in 2019 and 2020 when interest rates were lower, in some cases much lower, those mortgage renewals are going to be a much larger payment shock to the system. Luckily, we do think that hopefully by then, at least the mortgage rates have decreased. So unfortunately, those that took mortgages in 2018 and are coming for renewal in 2023 are definitely getting a short end of the stick. You took interest rates when they were, or took a mortgage when the interest rates are higher in 2018, and you're coming for renewal when, again, they're higher and at or very close to the peak, it seems. Now, on top of mortgage renewals, I'm adding in another feature here too, which is private mortgages renewing. And the reason I have that here, or even B-lender mortgages renewing, is that most of these types of mortgages are done on a short-term basis. So a lot of the time you'd have if you take a 1-year term, for instance, or if you took a private mortgage, a lot of those are on a 1-year term. B-lenders are 1-year or 2-year terms most of the time. And so borrowers that went into those mortgages and are and have difficulty qualifying with major banks are finding that they're coming for renewal now. And number one, on private mortgages and B-lender mortgages, we're seeing across the board that the rates are increasing about the same as the prime rate went up, about 4 or 4.25, which is a really big jump, considering you may have taken gotten a private mortgage last year at 6%, and now it's at 10 or 10.5%, which is not uncommon. And so we're seeing a lot of spikes in and not only those that are holding a variable rate mortgage, but also just those that are coming up for renewal, especially those that took private mortgages. We've also found those that have private mortgages that are coming up for renewal. Some private lenders are not interested in renewing that mortgage. And so we're having borrowers come back to us and say, hey, but my private lender is not renewing the mortgage. What other options do I have to take the mortgage somewhere else? So that's another challenge that some people are running into. We're hoping that doesn't become too much of a trend, but it is something that we're running into and keeping a very close eye on. So given all of this, what are your options? If interest rates are rising and you're having some concerns about being able to make your payments, not just the mortgage, but just in general, let's go through a to-do list. The first thing is to wake up. Second thing is get some coffee. And third thing, let's go through all of these and figure out what we're going to do here, and put you in a position where you can actually afford all of your mortgages and all of your payments. And it really goes through this step-by-step basis. And the first thing is just to cut expenses. The second thing is to hang on. I'm going to talk a little bit about hanging on and what that means. Obviously, the third thing is if you have debts, you need to restructure that. You need to try to get a control and get a handle on that. And the fourth thing is looking at what mortgage options you have. If doing all of these, cutting the expenses, understanding that rates will probably come down in the future, and by restructuring your debts, if you're still finding that, hey, this isn't enough, I need to find another option, then that's where we have some mortgage options and mortgage products that may be a good fit for you too. So the first thing is really important to look at your budget and look at cutting expenses. If anytime a business goes through a circumstance like this, what do businesses do? They start to lay off staff, they start to cut expenses, they cut back on their marketing budgets, they do all these types of things. And so just like a business, you have to do the same thing, especially if you're running a lot of rental properties, et cetera. If you have a real estate portfolio, you need to start to figure out, okay, what expenses can I start to cut back on, review the budget, and frankly, do what the government wants you to do, which is to spend less. The reason we have an inflation problem is partially due to spending habits. There's more money sitting in people's bank accounts today than there ever has been, because COVID caused a lot of central banks to just print money like it was going out of style. What does that mean? More money chasing less things, which means inflation. Obviously, the other concern and issue we've had with regards to inflation is just that there's been major issues with the supply chains, and that's causing some prices to go up. A war in Ukraine is another reason why oil prices and gas prices have gone up. But at the end of the day, what the government can control is by increasing interest rates, is causing people to spend less money. And that's really the main focus of doing this. And so step number one is make sure that you go through your expenses, do a budget, and figure out what are some of the expenses that we need to keep and which ones can we look at cutting. If you need a budget book or any help with that, please let us know, and we'll be happy to send you over a bit more information that you can use to help create a budget. The second thing is hang on. Now, the reason I'm saying this and why I'm putting this as an option is that rates are predicted to go down. And so that question comes up a lot. What in this market, are rates going up or are they going down? Well, we're watching this a lot. And this is the inflation chart. And you can see that it had peaked back in about June, July of this year. But it's starting to get a little bit more under control. So you can see that the interest rates or the inflation rates are starting to decrease. The Bank of Canada is still far ways away from having the inflation numbers under control. And these inflation numbers, this is something not a lot of people are aware of or familiar with, but these inflationary numbers are the year-over-year data. And so they're tracking year-over-year how inflation is decreasing. And so as we start to get into January, February, March inflation data, we are expecting that number is going to continue to come down. Also, an important data point that we're looking at too is instead of the year-over-year, it's also the 3-month data. And for some reason, the Bank of Canada doesn't like to publish this information a whole lot, but the 3-month inflation data is showing much better numbers and is giving a lot more faith in what's happening and a lot more faith in the fact that the Bank of Canada is doing their job, raising interest rates to cool the inflationary environment that we're in today. Now, if the inflation numbers are decreasing, then what does that mean for interest rates? Now, after what happened last year, I don't like to do a lot of predictions. It seems like myself and really I get my data from major banks and other people that are much smarter than I am. But every time that things happen, there are always people that are betting on what's going to happen with regards to interest rates. Let's take a look at the bond chart again, just to get a general sense. So earlier in the presentation, I showed you the bond chart as it was going up, and it was climbing up to that 3.8% figure that it had reached. So back in October 19th is the date here that I was able to locate and pinpoint. The bonds hit 3.87%. Since then, you can see that there's been a couple of spikes, but overall, the interest rates or the bond yields have come down. Now, in fact, they had reached a low point of about 2.8% not too long ago. That's a full 1% difference between the peak and the trough. Now, we don't know what's going to happen in the middle, and frankly, we're probably going to see more zigzaggings and more wiggles in the middle here. But the general expectation is that bond yields will slowly start to go down heading into the end of this year and into next year. In general, in a recessionary environment, interest rates typically do come down a little bit. And one of the things that that we're expecting, and more and more economists are predicting this, is that we're likely to have a light recession sometime in 2023. We're starting to move towards that. And so interest rates are starting to adjust and react to that information and react to that news. So we're seeing rates come down. And what does that mean for anybody in a fixed rate mortgage? Well, it means that interest rates are coming down. We're seeing a number of major banks under 5% for 5-year fixed rates. And even for 4-year fixed rates, 3-year fixed rates. For insured mortgages, we have lenders that are offering 4.59%. For uninsurable, from 4.69 to 4.79% in best case scenarios. Most banks are still around the 5% or over 5%. One thing that's very interesting, however, we're looking at the 5-year bond chart right here. However, short-term interest rates, like 1 and 2-year rates and bonds, are actually much higher than 5-year rates. And one of the things, if you ever wanted to predict an upcoming recession, if you notice that the bond yield has inverted, and what that means is that usually the longer the bond, usually the higher the interest rate offered. If that flips and short-term money is more expensive than long-term money, then that's a sign of an upcoming recession. So one of the tools that people follow and track is the difference between the 2-year treasury bond in the US versus the 10-year treasury bond. And right now that spread is the 2-year is about 100 basis points, so 1% higher than the 10-year money, which is uncommon. You don't usually see that unless it's coming before a recession. And this indicator is a very good indicator of upcoming recessions. So interestingly enough, if you go to take a 1-year rate or a 2-year rate on a mortgage, you'll probably be paying a rate of 5.5%, maybe even 6% on that short-term rate. But if you could take a 3-year rate, rates are getting down to about 5%, 4.99. A lot of lenders have around a 4.99% 3-year rate right now. And then 4-year rates and 5-year rates with many lenders are even lower than that. So we're in an interesting spot here where fixed rates are actually starting to come down, especially the 5-year interest rates are starting to come down. Now, what's happening then? It's expected this year anyways that the fixed rates will be relatively flat. We're not anticipating that the rates will continue to decrease significantly this year, but the expectation is probably flat, maybe slight downward pressure overall over the year as we reach closer to the end of 2023. And then the prime rate is a tough one. You know, what is the Bank of Canada going to do? Because last year, a lot of people were wrong on how high the Bank of Canada was going to go. Most people predicted the Bank of Canada would have hit a prime rate of about 4.45 or 4.7%. We ended up hitting 6.7% just a week ago on the prime rate. So we've overshot that expectation quite a bit. As of right now, if you look at what people are pricing in and betting on effectively, they're betting on possible increases this year into the spring, maybe no increase, maybe a 1/4 point. It doesn't seem like anybody is really predicting more than about 0.5% in total increases during the year. So it seems like we're at or very close to the peak. However, it's interesting, as soon as central banks say, oh, it looks like inflation might be under control, then people go out and start spending again, and then, oh, never mind, it's not under control. So the Bank of Canada is very wary of signaling to people to go and spend again, and that causes the inflationary figure to jump up. So they're definitely cautioning people not to go out and spend money. However, there are some people now that, based on this information, based on where we're at, are actually starting to price in rate cuts by the end of the year. So a few economists are predicting that perhaps the Bank of Canada goes down later into 2023, like in October and December, possibly dropping a 1/4 point at each of those meetings to slowly ease up. Now, if you're a betting man, then maybe sure you anticipate that based off of what information we have today. However, I don't think that it's prudent for you to expect that. Maybe you shouldn't be taking a variable rate thinking, oh, I'm going to take a variable because I know for sure rates are going to drop later this year and they won't go up anymore. I still would be very wary of that. It's a very uncertain time with inflation. And so it's important to be cautious about this. But if you're not sure about where rates are heading, then this is the current prediction that people are putting out, is that maybe slight increases and nudges up, but also an expectation that perhaps by the end of the year we might be coming down. I would still be cautious of using that, however, and I would say maybe assume that maybe first quarter of 2024 is maybe when we see rates start to come down a little bit with the Bank of Canada. I know they want to keep it high just to make sure that they fully attack and kill the inflation. Now, obviously, restructuring the debt is very, very important. If you bought a new car and a new house in 2021 and 2022, which a lot of people did, and all of a sudden now your payments are going up and you're starting to carry money in your credit card, this is where you might want to look at restructuring your debt. And obviously using your home as collateral to do that is one of the easiest ways to get cheap credit. And so if you're not sure about whether you can qualify or whether you should do it or not, we've developed a spreadsheet that's a calculator that helps us punch in your current mortgage rate, the new mortgage rate. It can help us figure out what the expectations would be for even if you took a variable or a fixed. And more importantly, if you're carrying debt, even if you're at a lower interest rate today, but you have to refinance and move it to another lender, we can run the numbers to see if paying off the debt would reduce your overall payments, because maybe your mortgage rate and payments will go up on the mortgage, but by being able to pay off more debt, maybe your overall picture becomes better. And number two, we can also look at your total interest costs, because in general, even though mortgage rates have gone up, credit cards and other unsecured lines of credit, a lot of those are still more expensive because they have also gone up too. And so this is something where in general, the house results in you being able to get the lowest debt possible, the lowest rate. And that's because it's a mortgage, it's more secure. Whereas other forms of debt usually are either unsecured or secured by depreciating assets like a car loan. So if you're carrying debt, or if you think that you might be in the future, then getting access to some credit and trying to restructure your debt ahead of the curve is really, really important. And then we can generate a little bit of a report for you to kind of shows you, what your savings would be if you would save money by refinancing or not. And it factors in your penalty to break your current mortgage and paying out all of your debts and all of that. Now, of course, there are also mortgage options and ways that you can reduce your payments on your mortgage too. And so we want to go through a number of these different ways that you can reduce your payments right now. And one of the things that's coming up quite a bit right now is finally, now the interest rates on the fixed side have dropped enough and the Bank of Canada keeps nudging up variable rates. A lot of our variable rate holders are now considering maybe locking in their mortgage. And so now we have a few lenders that are offering sub 5% interest rates for 3-year, 4-year, and 5-year fixed in particular. I still really I think, in my opinion, in 2 years' time, I think that'll be a good time to be coming up for renewal, because I think rates will be lower by 2 years. Not absolutely sure, but pretty sure. 3 years, however, is a lower interest rate than the 2-year rates are right now, usually by a pretty large margin, like 0.5% or more in some cases. But in addition to that, we're quite positive that in 3 years, interest rates are more likely to be lower than they are today. 2 years, probably, but who knows? But 3 years is a bit more of a solid bet. So you're not locking in for too long, because we do think that if you take a 5-year fixed rate today, you're probably locking in at or very close to the peak, and we're not a huge fan of that. And that's where the 3-year fix seems to be that value point where you're getting a low interest rate, but you're not locking in for too long. So one of the things we're asking our clients to do is, if you're interested in or thinking about this, especially if you're in a variable rate mortgage and maybe you're at prime minus 0.5. So right now, prime is 6.7, prime minus 0.5 means you're at 6.2%, and your payments are based off of 6.2. Well, if you could lock in to a mortgage at 4.99%, you're dropping the interest rate by 1.2%, which is going to drop your payments considerably. You could probably drop your payments by at least a couple $100s a month if you have a mortgage of, let's say, $500,000. Now, if your bank is not willing or able to offer you a competitive interest rate to lock in, let's say that they're offering you 5.5 or higher, even if you have to pay the penalty, it often will make sense to move the mortgage to another lender, because you can often either roll the penalty up into your existing mortgage, or lenders sometimes can what's called capitalize the mortgage payment on a transfer in. So they just take a few $1,000s of the penalty and can add it to the mortgage balance. And some lenders are offering cashback incentives. So you might even find that a lender's cashback incentive might help cover some of that penalty to move the mortgage over. We have some lenders that are offering up to $5,000 in cash back to move the mortgage over to them right now, which could help with any penalties that you might face. So if you're in a variable rate mortgage, then it may make sense to consider locking in and do the math. And if you need some help, you can reach out to our team and we can help you run the math and figuring out what would your new payments be if you locked into a 5-year or a 3-year fixed right now. Again, still recommending in general the 3-year fixed. Run the numbers and see if it makes sense. Then the next step would be to contact your existing bank to see what kind of rates they would offer. And if they're uncompetitive on the lock-in, it may make sense to then break the mortgage and move it to another lender. Another option is just to extend the amortization. If you took a 25-year amortization 5 years ago, now you're at 20 years and you're coming up for renewal and you're seeing, oh my gosh, my payments are going to skyrocket when I come up for renewal. Just remember that you can also re-amortize the mortgage. Now, some banks will say, or some lenders will say, well, if you're re-amortizing the mortgage, then we have to re-qualify you. So you have to go through the mortgage process all over again instead of just signing on the dotted line for the renewal. And if that's the case, then that's something where you may want to look at all of the different options available to you. Maybe your bank may or may not be the best fit and be offering the best interest rate on that renewal. Even if you're in the midstream and you're not coming up for renewal, you can still go through a refinance process. And sometimes the banks will allow you to extend the amortization out to 30 years. Sometimes you need to move it to another lender and just refinance it to get the 30-year amortization. So just remember that if you're underneath 30 years, extending the amortization out will reduce the payments. There is a declining benefit to doing that. If you're going from 20 years to 30 years, you're going to have a pretty decent chunk of your payment dropped off. But if you're going from 26 years to 30 years, it will be less impactful. Another thing that's really important is just getting access to credit. So if you're concerned about being able to afford your payments on an ongoing basis, then go get a HELOC or a line of credit right now. And if you need to, for a short period of time, you can use the line of credit to service payments for a period. And it's really important, I can't stress this enough, get the credit before you need it. Because if you start getting behind your payments and then you go to the bank and get credit, or I should say go ask to get credit, guess what? They're usually not willing to give it to you at that point. Really important, always get credit before you need it, because when you do need it, they're less willing to give it to you. And we have some clients that are in a tough spot right now. They're not sure if they're going to be able to afford their mortgage payments. Maybe they already have one, or they're getting a line of credit or a HELOC, and they can use that HELOC to at least help just kind of bridge the gap for a little bit. The next up, this is a unique one too, a reverse mortgage. So typically you need to be 55 plus in order to have a reverse mortgage. However, there are also other products with private lenders that also offer reverse mortgages at higher interest rates where there's no payment. And for most typical reverse mortgages, if you're 55 plus, there's also no income qualification required. Now, there's an interesting product with Manulife called the Manulife One, where we can also set you up with that. And you can use your Manulife One like a reverse mortgage as well, where you don't even need to make the payments. As long as you have the available credit, they can keep adding your payments to the outstanding balance. And you can just make whatever payment you're able to afford every single month. And so you can treat, with the right product, your mortgage like a reverse mortgage, where you just make as much of a payment as you can afford every month. And the reverse mortgage is a really interesting concept here too, because we have some of our clients that are using this as a retirement strategy. So what they're doing is they get a reverse mortgage on their home, take the lump sum cash, buy a rental property. Now the rental property is generating income. And what ends up happening is you're able to write off the interest that accumulates on your reverse mortgage. So even if you don't have a payment going out, because there's an interest amount that keeps accumulating, you're able to write that interest portion off on your taxes and reduce your taxable income and write off against that income that you're generating against the property, even though you don't have a payment going out. So you're collecting an income on that property. You didn't even have to make payments on it or anything like that. And so you've increased your income and you're able to have a larger tax deduction because the interest cost is accumulating. Now, I always will preface this by saying, make sure you talk to your accountant if you're going to look into any strategies like this. But it's an interesting strategy for those that are 55 plus and wanting to generate some extra income for themselves. You can actually get a reverse mortgage on your home, use it to buy a rental property, that generates income for you, and you don't have a payment on the reverse mortgage. Now, if you're really in a bind, you can get a second mortgage if you really need credit, or if you're starting to get behind in your debts. So if you've already got behind in your debts and you can't afford to pay them, or you're just worried that you're carrying a lot of debt and your credit rating is decreasing, keep in mind that if you get a second mortgage and clean off all the consumer debt, it will protect your credit rating. So this is really important. We have a lot of clients that in the next year or two, and especially when rates start to come back down again, they're going to try to refinance to re-correct and fix the financial situation that they're in right now. It's really important that you don't rack up too much consumer debt and then go to refinance in a year or two and then find out that you don't qualify to do so because your credit has taken a nosedive. So if you're in a situation where you're concerned about this happening, if you get a second mortgage on to keep the balances low on all of your consumer debts, it will preserve your credit rating and make it easier for you to then refinance and pay off the second mortgage in a year or two when your financial situation improves. Now, the last thing I'm putting on here is kind of the opposite of what we talked about. Most of these are people that are trying to figure out, how to afford their payments, or a bit more of a distress situation. However, another thought here is that interest rates going up doesn't have to be bad for everything and everybody. Interest rates going up means that certain assets are now generating a higher rate of return. GICs are now offering 5% in some cases on a GIC, which is really high. We haven't seen that in a really long time. Private lending rates have also gone up, and this is another example of something where interest rates going up is allowing people to generate a higher return. We've had some conversations with some of our investor clients, or just those that have money that are sitting in RSPs or in other in invested assets. Some of you are pulling out money out of mutual funds because the stock market has been quite poorly for the last 6 or 12 months. Pulling that money out and then putting it into private lending, and you could now be a lender and generate 9 to 12% return on a monthly basis because you're collecting a mortgage payment directly from the borrower every single month, generating 9 to 12% return on your money. And that income could be used to help you cover off your other debts, especially if your mortgage payment or mortgage rate is lower than 9 to 12%. While you can take these assets, instead of paying down your mortgage to reduce it, you can instead invest the money into something else and generate more in income, which could then be used to help you service your own mortgage payments. We've had more inquiries for people wanting to become a private lender than we've ever had in the last 6 months. A lot more people are trying to figure out, where do I put my money? And being a private lender is a very common strategy there. So if you want to learn more about that, we have done webinars all about being a private lender, and we encourage you to go check those out. One of the really important things is just to shop your mortgage renewal. If you're coming up for renewal this year, or in the next 12 months or so, it's really important to shop it around. We're finding now more than ever, there's a big gap between some banks and some others. Some banks like TD and HSBC are really competitive right now in interest rates. And some banks like Scotiabank right now are way less competitive on their rates. And so if you're with Scotiabank currently, then their interest rates may be much less competitive, and you may not be able to get as good of a deal when you come up for renewal with them, or if you're trying to refinance with them. So it's more important now than ever to actually shop the deal around and figure out which lender is going to be the right fit for you, especially if your mortgage was insured, so you put less than 20% down when you bought it, or you fit other classifications, which means the bank can still get insurance on your mortgage. So even if you put more than 20% down payment, if you fit certain criteria, better interest rates may be available for you than your bank is offering you. So make sure that you shop that around. It doesn't take long to just get the renewal letter, check in with our team, and we'll be able to confirm, yeah, you know what, that's a competitive rate, or you know what, we could probably move you over here and save you 0.3% on your $500,000 mortgage. That might be $1,500 a year times 3 or 5 years. It's a decent chunk of change, especially now more than ever. Now that interest rates have risen this much, you need to be watching and trying to save money where you can. Now, a couple other things that we want to just talk about really quickly here. I'm going to reiterate this once again, that you do want to consider, especially if you're concerned about making your payments, the 3-year fixed at 4.99 seems to be a pretty good value in my opinion. It's not too long of a term, but also at least is a reasonable interest rate. The 2-year rates seem to be just a little bit too high right now to really encourage people to go into, and it doesn't generate enough of a savings in the monthly payments. But if you're having difficulty qualifying, for instance, there are some net worth programs There are programs for self-employed borrowers, reverse mortgages. There's no payments needed, and the qualifications are a lot easier. There's also B lending and private lending. So if you're running into challenges where you just find that you just can't qualify, and you versus the bank, you guys are having a bit of a tug of war, just keep in mind that there are options available for that, including higher debt servicing programs, et cetera. And I think for some reason this slide, just repeated a bunch of things. One of the things I wanted to mention is just that every lender is different, and everyone has different policies. So if your own bank is saying, yeah, you know what, we can't do this deal for you, it does not mean that another bank can't. I'm spending a lot of time right now actually developing some software that goes through and helps us underwrite deals on our end to understand where a deal can fit. And I'll tell you, there's a lot of different policies out there, and it makes it very, very complex, and it's very difficult to know if your bank just says no. Well, maybe there's another option with another lender. So just keep that in mind, that if your bank says, no, you can't get a mortgage through us, there are other options that may have better policies. I'm changing and updating a spreadsheet that I've been using, where it allows us to punch in a client's portfolio and all of their properties and all of their situation. And it actually runs the numbers and confirms the debt servicing ratio is and the different options available. We're adding a number of different features into that. And we're hoping that we can actually roll that out by the end of February. So anybody who has a complex mortgage, we can actually assess their situation without having to get any documents from the borrower, and look at all of the different options and actually advise what rates are available with the different options and different lenders, and the maximum borrowing power available with all those options. So we're very excited to roll out that tool, targeting probably, I'd say, end of February, early March, to be able to roll that out to our customers and start to use it. So we're just kind of entering the testing phase, just to make sure that the numbers that we've calculated are balancing and making sure there's no errors or mistakes in the multitude of formulas and calculations that are embedded in that. I don't want to spend too much time on this particular topic, but I do want to talk a little bit about this, because I'm going to be doing another offbeat webinar in late February. I haven't booked a time yet. There's a lot of changes coming down the pipeline, most of them with regards to rental properties, but some of them are just in general. But the Office of the Superintendent of Financial Institutions is looking at a lot of different things. And one of those things is looking at perhaps increasing the down payment for rental properties, which would definitely have a large impact on the return on investment. If you have to put 25 or 35% down on a rental property instead of 20%, that's going to really affect your bottom line as an investor on your overall return on investment. Not to mention there's other formulas and other things that they're now starting to consider perhaps using in order to make it more difficult to qualify. And unfortunately, a lot of these things are going to make it harder for real estate investors to buy real estate. So we are putting together a bit of a synopsis of this. We're sending more information to everyone. And so we're targeting, again, end of February, where we'll send out a little bit of a PDF that explains what's happening and all the changes that are on the table right now. Nothing's been formalized, but the problem is that once the government decides they're going to do something, you'll have very little time to react. So we want to make sure that we give our customers some upfront notice so that they can start to prepare for some of these rules that might be upcoming. So what are our clients doing? A lot of our clients are increasing their home equity lines of credit. There are opportunities that are coming in this marketplace. And interestingly, I've observed, and almost everybody else in the real estate market that I talk to is observing the same thing, which is that the real estate market is starting to heat up right now. More people are getting offers written. More people are getting accepted offers. More people are taking action and doing things. It doesn't mean that the market is necessarily hit the bottom. This might be a little bit of a bottom, and then it might continue to drop in a few months. Who knows? However, it's important to just get ready and prepared. And the investor clients we work with, most of them are just getting ready and getting access to capital because they want to be able to pounce if a good opportunity comes up. Another thing a lot of our clients are doing is parking money into better short-term investments, like private lending, into a mix, which are mortgage investment corporations, so that are pools of investors that lend out on properties, or even GICs. I mean, it's crazy that I'm even recommending GICs, but I don't know if the stock market's going to have a 5% return in the next 6 months. Maybe it will, but it's hard to resist a GIC paying 5% for a 1-year period, just to see what happens, you know. Another thing is just getting pre-approved to take advantage of opportunities. We're starting to see it, and I think we'll see even more of this coming up in the next little while here. There are going to be people in tough situations that are going to need to get their property sold. If you're pre-approved, ready to go, and you can close quick, you'll be in a better position than most to take advantage of that situation. And then the last thing is just either figuring out whether you're going to ride out the variable rate wave here, knowing that it's going to stay high for probably another 12 months and then start to decrease, or maybe it's time to consider taking a short-term fixed rate. And I think the answer to that is generally, what is your current discount off of prime? If you're at prime minus 1%, that's a pretty decent discount. Maybe it makes sense to just hang on for a little bit longer, especially if the Bank of Canada starts to decrease by a quarter or 0.5% in very early 2024. That's going to bring you down to what kind of levels you would be locking into as of today. But keep in mind, if you're worried about making your mortgage payments and worried about another inflation bump and rates going up even further, it may make sense to consider going into a short-term fixed rate. So if anybody has any questions or would like to clarify anything, feel free to reach out to our team and book a consult with us. Myself, Michael, Alex, our account managers, very open to having a conversation with you to discuss what's available in the marketplace, what options you have, run some numbers on what your payments could be, what options you have on your mortgage to decrease your payments or restructure your debts, etc. I am a best-selling author. I wrote Rockstar Real Estate Investing, and anybody that does not have a copy of it, please send us an email to info@greenmortgageteam.ca. We'd be happy to send you a copy of the book. If you have any questions, you can go to our website, greenmortgageteam.ca. You can email us at info@greenmortgageteam.ca, or you can call us at 229-5515. I will now open it up to the Q&A and answer what questions people have. All right, Sam asks, hi Kyle, do you get notified of updated policies for each of the financial institutions you work with? Yes, so in general, most of the lenders, when they update policies, we do get notifications. We also are a very proactive team. A lot of our clients are very complex. We're always reaching out to our contacts to make sure that we're also checking, hey, here's all the policies that we have. Can you verify that these are still correct? And so we have a really good handle on this. It's incredible how many little nuances and how difficult it is to actually scan the marketplace and understand what everyone's underwriting policies are in this climate. Hey, Nick, nice to see you. The lenders offering 499 would be TD, HSBC, and a number of non-bank lenders. So there's quite a few lenders that are offering it. But the major banks right now, TD and HSBC, are leading the way. We have an anonymous question. So if you're in a variable rate mortgage and wanting to lock into a fixed 3-year term, would there be a penalty to do so, assuming you have to stay with the same lender? So the answer is no. So generally, if you're locking in with the same bank, there is no penalty to lock in. And that's why you just want to check with them first before you decide to break it and move to another lender. But sometimes there are situations where it can make sense to pay the penalty, break the mortgage, and then move it to another lender, but only if the rates are fairly different. In general, it works out to be about a 0.5% difference between your rate that your current bank is offering and the new rate, unless there's cash back being offered by the new bank, which could bridge that gap. And so even if it's a 0.25% difference, a higher than 4.99, you really should be reaching out to our team just to run the numbers and see what you might qualify for. Maybe there's a lender out there where a lot of the mortgage penalty would be covered via cash back. So it may make sense. Emad would like a copy of the book, of course. So email us at info@greenmortgageteam.ca and just put in your mailing address in there, if you wouldn't mind, and your name, and then we'd be happy to send you a copy of the book, Emad. Olga, your example is so taken out of my real life. Thank you for a timely topic. No problem. It's a tough time for a lot of people, but it's an important thing for us to try to communicate with everyone and just make sure that people are understanding of where they're at and what their options are. And if HSBC is pulling out of Canada, what will happen with mortgages? So we've had lenders leave the channel before. Because mortgages are bundled up and sold, and they create cash flow because it's a spread between what they're paying investors and what they're receiving from customers, somebody else will always buy the book. That somebody in this case, however, is going to be RBC. So RBC is going to be buying all of the HSBC mortgages. and all of HSBC. So any mortgages funded with HSBC will eventually become an RBC mortgage at some point in the future. The mortgages will not change until they come up for renewal, at which point RBC would be the bank that would be offering the renewal as opposed to HSBC. We're still interested to see. It's possible that RBC might say, you know what, for a mortgage division, maybe we'll continue to operate this underneath the HSBC brand. But it is our understanding that they're going to buy all of HSBC and then we'll be rebranding all of HSBC as RBC at some point. I've got a question. I purchased a pre-sale condo estimated to be completed in 2025. Can I start a mortgage application? Yes. So you can start a mortgage application. In general, most lenders will offer a rate hold for anywhere from 18 months to 2 or even 3 years. Some lenders can offer a full approval for 18 to 24 months as well. So this might be a situation where we would get an application, have it all ready to go, monitor rates. If rates keep slowly decreasing, then we just kind of wait on it. But then if rates start to move up or your financial position might be changing, then we would send in the deal. At that point, the 18 to 24 months clock would start ticking, but you can actually get an approval from a bank and fully get approved now, which actually means that even if your financial situation changes in the future, they're still giving you that mortgage. So it's a very important thing to consider doing. The rate holds are usually between 2 to 3 years, but sometimes for some people, it's even more important to have the full approval 2 years in advance. Cam has a question. If it's going to be harder to get loans for investment properties, I'm assuming it's not a good time to buy or sell. Worried that we won't be able to buy or buy as easily in the future. It's an interesting point here. So the question, I suppose, is what will happen to real estate values in the future if it's harder for investors to buy? Now, traditionally, investors were always about 5 to maybe 7% of all residential sales in Canada. In 2021, however, that number had skyrocketed to closer to 20%, primarily because of the low interest rates making a lot of sense. So it'll be interesting to see what happens to the real estate market moving forward. But in general, real estate investors on the residential side don't move the needle enough to completely jolt the marketplace. I think that interest rates dropping is actually a bigger one. I have a feeling that we have people jumping back into the market for right now for 2 reasons. Number one, the real estate market has not dropped as much as expected. And number 2 is rates. So number 1, the Bank of Canada is signaling that, hey, you know, we're probably at or very close to the peak. So people understand and feel, okay, good, it probably won't go up anymore. And with the other thing with rates is that I think that underneath that 5% mark, you're seeing the 3-year, 4-year, and 5-year fixed rates now being below 5%. I think that that's it's a psychological item. And I think people are starting to say, well, at 5%, I can afford it. So it'll be interesting to see. I think, Cam, what's probably more important, this is actually part of my homework. I'm very interested in seeing what is the return on investment if you bought now with 20% down versus buying in the future if real estate values drop a couple percent, but you buy in the future with 25 or 35% down. I have a feeling that the return on investment will still be a bit higher buying now and putting 20% down, but I'm very curious to see what happens in the reverse. So I'm going to be putting that together and actually going to be putting that out in a PDF and sending it out to everyone that that is in our database. Okay, so there's one more question here. Another question, since you mentioned GICs are paying 5%, which is decent, what is your opinion on getting into equity-linked GICs? They're usually 3 to 5 year terms. So the problem with a 3 to 5 year term on a GIC is I don't know if I want my money in a GIC for 3 to 5 years. The reason that a GIC is kind of attractive right now is because 1 and 2 year rates are very attractive and they're higher. So they're very closely tied to the bond market, et cetera. If we're expecting interest rates to drop in the future, and for other investing opportunities to become more attractive in the future, then I wouldn't want my money locked in for 3 or 5 years into a GIC. Traditionally, a GIC is a low risk but low yield product. However, with the short-term rates being very high, I wouldn't mind putting my money into a GIC for 1 year at 5%. And then in a year from now, I have more comfort investing it maybe back into stocks or maybe buying real estate or whatever at that point in time. But I wouldn't want to be putting my money into a 3 or 5 year term into a GIC, in my opinion. But everyone's different. And some people are going to think, you know what, it is a low risk investment, and you just have a lot of comfort in knowing that it's in a low risk investment. Question, is it true that some lenders don't look favorably on the 55 plus age restricted complexes? Absolutely. So anything that restricts marketability of an asset, such as this, is something that lenders don't like to do. Interesting fact, actually, is that CMHC does not insure age-restricted properties because they don't condone or believe in discrimination, and this is a form of discrimination. And so, because CMHC won't insure it, that's one of the 3 mortgage insurers in Canada that will not insure these types of properties. And so, anytime that you have something where it's harder to get financing, banks start to pull off. And the second thing is, anytime you have less marketability, if only 55 plus individuals can purchase in a specific complex, if a bank forecloses on that property and wants to get rid of it and sell it really quickly, it may be more difficult if they're selling to a much smaller segment of the marketplace that could buy into it. So it really comes down to primarily marketability, because of the fact that if they have to foreclose on it, they want to make sure that they can get their money back and get it back quickly. Okay, I think I answered all the questions. Are there any other questions? Anybody have anything else that they'd like to share or ask? Yeah, I know it is surprising. I don't know which bank. I think it might be Equitable Bank, Olga, that was offering something around 5%. So check it out. Might not be a bad spot to just park some money for a short period of time. Awesome. Well, I think that's all the questions. Thanks everyone for coming out and attending the webinar. If there's any follow-up questions, please reach out to the team. Send us an email at info@greenmortgageteam.ca. Be happy to help. And looking forward to seeing you guys all on the next webinar. Okay. The next webinar, by the way, will be on March 1st, and that's first-time homebuyers. I will be sneaking in another webinar off the beaten path, because I always do my webinars the first Wednesday of every month. But I will be sneaking another one in there to talk a little bit more about these potential upcoming changes with regards to making it harder to qualify and possibly needing larger down payments, et cetera, because I do want to talk about that. So I'll probably sneak that into the end of Feb, but I don't know exactly what day yet. But we absolutely will have one on March 1st, and that'll be talking about buying your first home and all the things that you need to know. So if you or any friends or family are considering maybe buying their first home, then that might be good for them to attend that webinar. So thanks everyone for coming out, and looking forward to seeing you guys all again soon. Thanks a lot.